Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending October 28th, 2016. Boy, what an interesting month for the month of October. Traditionally in the past, October has always brought in a lot of surprises. It generally comes at the beginning of the month, not the end of the month. And we've seen, some of the biggest drawdowns in S&P history, S&P 500 history, um, to the downside, and then we've also seen some of the biggest moves to the upside through the month of October in the S&P 500. Traditionally, the first 2 or 3 weeks in October is where all of the volatility resides. And then the last week of October, it tends to kind of go out, well, relatively quiet going into the stronger months in the finish for the year of November and December. However, this year, we're in the presidential elections here in the U.S., and it's a really unusual year because it's the craziest damn elections I've ever seen. Now, what I've got on the screen here is the S&P 500 futures, and we started off this morning, and I told all our members, don't necessarily look at the GDP number. Watch how prices react to the GDP number. And the number came out, and as usual, you typically have a little bit of volatility and a little bit of price chop around those numbers. Prices move down, they move up, they move down. They settled into a nice steady up mode, and they started moving up. And if I put us on let's put it on a 5-minute chart so that you can see the day. You can see right here, once we had the numbers coming out, right, at 8:30 in the morning, and let me just draw it on the screen for you so that'll probably help it a little bit better. Right at this point right here, this was when the numbers came out. They came out right in this area here. You can see it initially sold off, a little bit of a bump down. It came down again, tested this area down here, and then took off. Final test, and then we just kind of settled into a little slow, steady dribble here into what was going to be a relatively quiet afternoon. We were finding resistance at this price level that I've talked about now for, gosh, over a year and a half. Former all-time highs, 2134. We'll step it out a bit, and I'll show you just why this line is so important. But we were finding resistance at this point. I mean, we were poking our head up, but we were pretty much staying in this area. And then all of a sudden at 1 o'clock Eastern Standard Time, we had news come out in the U.S. that the FBI is reopening the email investigation into Hillary Clinton. So the markets immediately sold off. These are 5-minute bars. So within 5 minutes, we moved down right around, I don't know, about 8 points. And then in another 5 minutes, we moved down another 8 points or 10 points. And then, we kind of settled here, but then later on, we just kept right on moving down. So we went from a high up here, and it didn't take too long, right? We went from a high of around 2134 down to around 2113 roughly. So we moved, about 20 points very quick. So all in all, it really wasn't that bad of a down move. I mean, it was fast and sharp, but as sharp as it was down, we started kind of settling and moving back in and then kind of finishing right at one of our price levels. But what really shook the market a little bit was a fast move up in vol. And volatility, even though we started coming back up, vol stayed high the rest of the day, going into close. In fact, we closed the gap between the front month volatility futures and the VIX, which is where the implied volatility is projected right now. And it was really, I saw that as amazing. So, and it makes sense because if you think about it, the markets are carrying a lot of headline risk into the weekend. If you throw that email probe out by the FBI, the markets were pretty much resigned to the fact that back here, as I said, when the GDP number came out, it was better than expected. The expectation was about 2.5, and it came in at 2.9. I know some analysts were expecting 2.9, but most analysts were expecting about 2.5%. It came in at 2.9. And as you can see, we went from here up to here. So good news in the economy was interpreted as good news by price action. That's key. Because what that tells us is the market has already priced in this rate hike for December. Now, I don't need to tell you that because the markets have already priced in, or the 30-day Fed Fund futures has already priced in over a 73% chance of a Fed rate hike in December, and almost a next to 0%, probably 5 or 6% chance of a rate hike next Wednesday, which is our next FOMC meeting. So this tells me that with good news and markets wanting to climb higher, albeit very slowly and in kind of a grinding way, the market's resigned to the fact we can handle a 25 basis point rate hike as long as Janet Yellen, and as we say fondly and affectionately, aka Aunt B, comes out of that kitchen with a blueberry pie that just tastes really great. A lot of butter, a lot of fat, a lot of sugar, meaning that's what the markets want. So one rate hike, one and done, low trajectory for 2017. We're good to go. Everybody's happy. And then boom, we can just kind of grind a little bit higher. So that was good. And as we were going into the afternoon hours, in fact, I was ready to go to the gym. I had my all my workout clothes all set, had my iPod, my iTunes going. I was ready to rock and roll to the gym. And just as I got up, bam, that news hit the wire. Oh my goodness, it was really funny. Probably not for Hillary Clinton supporters, but it was amazing how the price action moved down and volatility literally popped. Now, why did vol stay higher even though the price is made up maybe about 40% of the down move from peak to trough? Because we got what's called headline risk. Now, the market can anticipate risk that is key price levels, volume support, earnings risk, things like that. But what the market cannot take is the unknown. And the unknown is over the weekend, James Comey, the FBI director, or someone else steps in front of the podium and says, okay, here's what we're doing. And they do a press conference. And then lo and behold, they find something that could implicate Hillary Clinton. And then boom, you're going to see volatility. You thought today was a strong move up. You haven't seen anything yet. You could see vol move up into the low 30s or high 30s inside of just a couple of days, up to the 40s. We got vol moving from 12.5 to 13 up to in the 50s with the Chinese devalue the yuan last August 2015, August 2015. Why did the vol move so high so fast? It was the fastest move in volatility in the history of the markets. Mainly a couple of reasons. One, it was a complete surprise. The markets weren't expecting it. So as you know by now, any kind of market surprise, the markets really go crazy, which is why the Feds try and communicate as much as possible a chance of a rate hike. So like when I say the Feds, the markets have priced in a 70 or 75% chance of a rate hike, then when they hike the rates, the markets don't go batshit crazy, right? It's pretty much priced in already. But on an event that is just totally unknown, or in the unknown unknowns, which is really the true definition of a black swan. You can't call a black swan unknown, meaning it's a binary event like the Brexit vote. It was a binary event. We knew it was coming. A true black swan is something that's just an unknown unknown. When it happens, it happens. And then after it happens, you get caught on the wrong side. You're overly bullish. You're going to get punished. Okay, or you've got too many credit spreads on, you're holding too much short vega and volatility goes through the roof, you're going to get punished. Okay, so these unknown unknowns is what unravels a market. So that's what we got this Friday at 1 o'clock. But it was really, in the scheme of things, relatively mild, but we got a taste of it. But what this has done, and the reason why volatility stayed relatively high, stayed bid going into close, even though price action moved up like this, is because of these unknown unknowns right now. Now we know what's going on, and now they're going to wait for a headline number and or a headline news event in a press conference or a statement by Comey. Now, he's under a lot of pressure because we got a presidential election. So what's going to happen relatively quick? And what we did in our group was, you know, obviously you don't want to be just laying on a lot of longs and a lot of credit spreads and putting on new trades with a lot of this going on. The smarter thing to do is you could probably go long some volatility, but don't load up the boat on it, because by the same token, vol is going to crash if Comey comes out and gives the all clear sign. Or let's say he comes out and says, Hillary's not implicated, we're going to leave her alone, we're going to go after one of her lieutenants. Then you'll see the market just kind of breathe a sigh of relief. Hillary will come out and, say, oh, I'm so sorry for her. We wish her the best. Then she's going to kick her to the curb, replace her or him with someone else, and then we're off and running again. That would be the Hillary style, I believe. Trump would probably do the same thing too. So I'm not trying to make a political statement. I'm just saying what price action is going to do. However, and then you'll see volatility crater. However, if it's the other side, you'll see, like I said, vol go up into the 30s and 40s very quickly. So we've gotten also a taste of what the markets think should Clinton not win the elections. So now we've got a good idea that the markets, we've got built in a little bit of a Clinton win, right? And anytime that's in doubt, you're going to see the market sell off a little bit. And I'm not making a political statement. The markets hate uncertainty. And with Hillary, there's certainty. Love it or hate it, they know what she's going to do. She's a known quantity. Trump is not. He is an unknown quantity. And he's going to talk about undoing a lot of trade agreements and renegotiating a lot of stuff. So the markets aren't making a political statement. They're just saying, hey, it's an unknown. Okay, so anything that's an unknown, whether we like the guy or not, it's just an unknown. So we're going to put a lot of volatility in there because we don't know what's going to happen. So you're going to see volatility probably stay elevated until this issue gets resolved. Okay, and you just need to stay light on your feet. So that's kind of what we saw here in this. Now, if it's resolved, then I'm going to make the assumption that vol is going to come down, and then we're going to have we're going to end up back up in this area again fairly quickly. Okay, it'll be just almost as quick as we came down. We're going back up if it's resolved for good. All right, and then leading into the election, if it looks like it's going to be very close, you'll see the market get very choppy because, again, it hates the uncertainty of one candidate versus the other. Okay, so that's a little bit about what we experienced today in the markets, and there's no need to panic on any of this stuff. I mean, it's just, it's kind of what it is, right? And you've been around the block enough, you know how this works. Now, you see here these former all-time highs. I'm going to take everything off my screen, and then what I'm going to do is I'm going to come back in, and we're going to come out to a daily chart here. And I think I've pointed this out before, but I'm going to show a couple of key things here. One, I'm going to show a key trend line. Okay, so here's this trend line coming back to the February lows, and let's just connect the dots right here, right? You can see here how we've already broken this trend line to the downside. Connecting the February low, this is the S&P 500 futures, and you can see where we're sitting here. This yellow line is the S&P E-mini futures 200 EMA. And you can see on this 200 EMA that it's still got a slight upward trajectory. The 50 EMA has got a slight downward trajectory. That suggests that they're moving closer to each other, which does, obviously suggest that, we're coming down into this kind of pattern right here. So I can draw two different patterns. I can draw that pattern like that, and I can connect this white line to this white line here. Or if I connected this line to this white line here, we've already broken. Traditionally, when you enter a symmetrical triangle, in the direction you enter it is traditionally the direction you break, which would mean that traditionally we would break to the upside. Okay, and that's what I believe we would probably have done eventually if this had not come out. Now that it's come out and put some turmoil in the markets, I think it's 50-50. Either way, we are winding this thing up for a zip higher or a zip lower. Now, we've already got a minor taste of all today going into close. But this is kind of where we're looking right now. And there are a couple of key pivots that I'm pointing out to you guys, and I'm staying on the same one. Key pivot 1, 2100. It's a big number, guys. If we take that out, we got the 200 EMA to hold us up a little bit at 2092. If we blow through it, we've got one more key pivot, and then it's away to the races. This 1981.50 was the Brexit low, okay? And I would expect this to hold. Keep in mind that The only thing that I think would get us down here is if Trump wins the presidency, it'll be like a Brexit thing. There'll be an initial shock, an initial sell-off, and then the markets will settle in, and then we'll determine which way it's going to go. Clinton wins, it'll be just the opposite again. And I'm not going to support Clinton over Trump or Trump over Clinton in this. This is just, I've got my own personal views. I think all my members know where I stand on this. But as far as price action, that's all we really care about, quite frankly. That's all I care about, and I'm sure that's all you care about. How can we make money on whoever wins? So these are the key levels, all right? It's going to happen quick. We've got the elections on November the 8th. We've got the FOMC next week. They're not going to raise the rates. I believe in the Fed Fund futures forecast of probably 6 or 7% opportunity of raising the rates. So that's about a 92, 93% chance they will not raise the rates. But what everybody's going to pay attention to is the comments and the chatter that comes after this. Remember, Feds cannot talk 7 days before an FOMC meeting. They're in a news blackout. And I know those rat brains just want to jump in front of a mic and talk because they love to talk. But they can't talk. They're not saying anything. They will, however, talk after the November 3rd FOMC policy statement, and then they're gonna race each other to the microphones to chat. So we got all of that to look forward to too. So I think volatility is going to stay elevated till we get to the November 8th elections. So these are the two key levels. Now that 2134 level, I will show you why that is just so damn important. If we come back here to May of 2014, this level right there. Well, that's not it. I missed it. I should probably have blown this up a little bit right there. Right there. 2134. That was the former all-time highs, and it took us over 400 days plus to break out of it again. It was a record. Anytime the S&P makes a high or an all-time high, generally it surpasses it within the year. But this was a record. It took us over 400 plus days to break that high, but we did break it. But now notice we've fallen back below that again. It's this breakout that does not seem to be holding, okay? That's not a good sign. All right, we've got a new all-time high right up here like this, right? 2192.69, I believe. That's the new high here. In the S&P 500, I believe that's what it is. Let me just see here and check and see. Yeah, 2191.50. That's the. Let me just check and make sure. 2191.50 is the prior all-time high. So this is kind of where we're sitting, guys. On a larger time frame, which we're using the daily here, these are the key numbers we're watching. Okay. Remember, we got the elections coming up. And we've got this pattern that it's sitting here just like that, right? That's what it looks like. We've already broken this first upsloping trend line. We've got the 200 EMA sitting just slightly below the 2100 level, okay? Slightly below there. So we blow through that, and there's not a lot stopping us down to this level here, okay? And what would get us down here? Probably a Trump presidency initially. So we'll play it and we'll make some money on it if that happens. And going long Vega because that'll be a good play, right? And what we'll probably do is watch the elections in the evening as the returns start coming in, and we'll play volatility futures. It's a great way to play it. I mean, that's how we played the Brexit vote. We were watching the poll results come in, and we were playing the pound and gold futures, and it worked out really well for us and our members. So this is why we're watching this very close, guys, okay? So I'm going to take this back off the screen, but you've seen it. I would highly encourage you to mark your chart up like this because these numbers, we come back and we're going to revisit again and again, either to the upside or to the downside, okay? So when I put everything back on the screen again, you can see here, there's all of the lines that I'm watching across the 15-minute, the 2-hour, and the daily chart, okay? And then you can see the 2016 open price, which I call a headline number at 2037.75. We can come down and test that very quickly. And it's a headline number because if we go back into the red for the year, that's the headline news story of every major business paper. Markets back in the red again, or the S&P back in the red. So we've got it marked. Now the other one that we're watching is the small cap. And if we look at the Russell, You can see the all-time high 2015 slightly above the 2016 high, which is 1263.50. We're sitting on the 200 EMA right now. You can see that as I blow this thing up here. And you can see the 2016 open price. Now the rut was doing very good. In fact, we came up and tested the 2016 high twice. As soon as just September 23rd, you know, almost 1 month ago, we were at 2016 highs for the rut, and then we proceeded to sell off. And we're working our way down. And if the 200 doesn't hold, we've got a wider support zone here, of which the 2016 open price is sitting in. Watch this very closely, folks, because this is also a measure of risk. Does big money want to take risk or not? Small cap, mid cap is usually the first to go south when markets are when money is seeking safety. And we've seen this started to happen back in almost 5 weeks ago. We've seen small cap and mid cap start to give it up. Now, I can't tell you just yet, is this a longer term trend that's going to bleed over into the Dow and the S&P, or is it just we're just taking money off the table until we get through the elections? I think that's what it is for now, but let's watch this and see. All right, we'll know for sure here in about another week and a half. We'll have this pinned down. But don't try and guess, all right? Guessing is a fool's errand. What we want to do is we want to follow the markets and the price action. That's where you really want to be. Now, if we look at volatility, and I'm going to keep it on the daily chart here for a second. If we look at the VIX, and I'm going to blow this up, you'll see just how the VIX here, over the past 4 days, really, right? Almost this entire week, we started off the week right down here, the VIX right around 1280, I guess, somewhere in that area. And then each day we closed there on Tuesday, here on Wednesday, here on Thursday, and here on Friday. Each day we've been ticking up in volatility. And you can see the peak up here like that, right? We just moved all the way up here, just slightly under 1765, right? And we almost took out the prior peaks right here, which will be very easy to do with another jout of volatility, okay? So we are in what I call zone 2. For those members, for those of you that are members, you know what I mean by these zones, right? We use these for our credit spread strategies, especially for those of you that have portfolio margin, and we're running ratio short strangles on the SPX. We use these, and now we're back into the yellow zone again, which means be very careful, because it won't take more than a day or two to get back into the pink and then into the red, okay? You can see the high for 2016 volatility was back here at 3209, which, you know, in the scheme of things is not that high, but that was right as we were falling through the floor in early January, through January into February, before we hit the bottom there. This was after the Feds hiked their rates in December. The Feds hiked their rates one time, back over in this time frame right there. As soon as they hiked their rates, that's what happened, and then it sucked people in and then went right back up again, and then we finally worked our way down as we went into the summer months here. So now the question is it going to happen again? I don't believe, given the political election, let's put that aside, I don't believe that is going to be the consequence this time. Remember, this rate hike here was not very well telecast or forecast by the Feds. There was still a question mark as to what they were going to do. But this one is very well forecast. In fact, 70%, 73% probably going to hike the rate. So I don't think we're going to get one of these pops in volatility if they hike the rates. The only thing that's going to drive vol back up here again is if we get continued email probe issues with the FBI or some other unknown event that we're not aware of right now. Okay. But I do believe if that settles in, we will come right back down and be in the top part of this green area again. But we're going to stay probably in the yellow through the election. I mean, I can just see that happening in zone 2 for volatility. Okay, so that's kind of where we are there. And if we look at the bond market, bonds were down a little bit. The bonds have been selling off, right? Now, we've been long TBT, but even today, bonds were down a little bit. You would think bonds, the markets would seek a little bit of safety with some of this stuff, but it didn't. The bonds are already resigned to the fact that, hey, central banks globally are going to stop stimulating their markets with more money. and you're seeing bond yields globally, not just the U.S., but globally, starting to rise a little bit. So you're seeing money get sucked out, but not to the extreme that we're going to see once inflation takes hold and we start to see Europe um, and possibly the Asian markets start to take hold as well. Once that happens, you're going to see the euro go up stronger, you're going to see other currencies move stronger, and you can see the dollar go down, and you're going to see bonds go down as well. All right, and they're going to really take a dive. For now, it's just going to be very choppy, but mostly bearish to the downside. You can see also the dollar reacted unfavorably to the action today. If I put it back on the 5-minute chart, you'll see how the dollar was, you know, it was doing nicely. I mean, it was, well, I mean, it was down a little bit, but, right up until 1 o'clock, right? And then this whole area here was the reaction to the US dollar. I mean, it cratered. It just fell off the bed, right? And then it attempted a rally, but then it came back down again. Why is that? Well, again, if Hillary does not win, and Trump wins, he's already promised he'll get rid of Aunt B, that would be Janet Yellen, and put in someone that does not make blueberry pie with a lot of sugar and sweets and candy and stuff like that. Be more health food. And when you try and feed your kids health food, what they do, they start screaming and crying. Well, that'll be the market. Longer term, it'll probably be good for the market, but short term, it's going to send the dollar. There's going to be a lot of fluctuation here, right? And it could initially send the dollar higher because of higher interest rates, but then again, it could roll right back over again. But we're getting some clues as to how the market is going to interpret all of this, which is really good for us going into the election, right? So the other thing that I wanted to show you guys, let's look at gold, which is the traditional fear index. And if we look at 1 o'clock, you can see what happened. Naturally, gold did what gold normally does, right? It moved up very strong. We got the notice right here. Away it went, and then it's just working its way back down. I think longer term, gold has still got a little bit ways to go to the downside. I'm calling it for down around 1200 area. Because that's where gold was headed, as you can see down here, and then you just all of a sudden it just shocked the system. But I think there's going to be a lot of forces pushing gold to the downside. So that's kind of what I'm looking at for right now with the gold market. Longer term, I think I'm bullish gold, but shorter term, probably bearish. And if we look at oil, oil had an interesting day as well. It also, it didn't sell off on the news. It really didn't. If you look at it, the news came out right at that point in time. And oil really moved sideways for almost a full hour, and then it gave it up real quick. There was probably some big selling coming on at that point in there because I'm sure what happened during this time frame here, a lot of people had some margin calls, some other things were happening, and they just had to adjust their trade, so they probably went into cash here, so they said, let's just sell out with oil. So I think we're going to come down here and chop around a little bit. I do believe we could go down a little bit lower, but I think there's going to be a lot of upside pressure on oil as well. And we've got a short strangle on here. We're at about 50% profit, so we're going to sit on it for now in the oil market. And that, guys, is where we're sitting right now. We're also in the soft market, looking at the meats and in the ag market. So there's a lot of things going on in this market. If you are not a member of our group, I would highly encourage you to come in and check us out. We got a lot of great things going on, and we seem to be having a good year this year. And I think the fourth quarter is going to be very exciting. Once we get through the election, we're going to start to establish a trend, and then we can really work that trend, whether it's going to be higher volatility into the downside or a grinding market with lower volatility or a strong bull move into the final days of the year. Either way, we'll look at it and we'll pick the appropriate option strategies and our futures and our synthetic trades, and we'll make the play. All right, guys, that's it for the weekend. Have a really great time, and I will see our members for a really fun Sunday night session, our weekly market watch. Take care, folks. Ciao now.